Hey harvesters, and welcome to Project Premium Harvest. My name is Matt. In today's video, I'm going to be going over the trades I executed for May 7th. We're going to be talking about my cash secured puts, my covered calls, how I strategically chose my strike prices. Then we're going to be discussing how this options trading has gone over the last 18 days. I switched over from high income ETFs over to my own options trading because I realized I can probably do it better and then don't have to deal with NAV erosion. And we're going to make a determination, is that the case? But for anybody that is a new viewer or potentially new subscriber, the point of this channel is to generate a daily, weekly, monthly, and yearly income. I have plenty of investment accounts for like 401ks, Roth IRAs, HSAs. I invest into rental properties. But the thing is how can I enrich my life a little bit sooner? And I definitely think options trading is one of them. So I want to make this as simplistic as possible for the common man to understand, because I want everybody to have this opportunity to access what money is. Money is financial freedom and gives you the ability to dictate how you want to live your life. With that being said, the first thing I usually talk on my channel is my account value, and it's currently at $91,499.53. Interesting enough, someone in the comment section asked, why do I care if my shares get assigned? And today is one of those reasons why I like to not get my shares assigned. And usually for my covered calls, I choose a very conservative strike price that is far away from the money, usually $5, $6, $7 away, is because in the after hours, you guys can see that I made about 0.62%. So I made about $567 of appreciation in the after hours. If I had these shares assigned, I would have lost this appreciation. So therefore, as much as possible for my covered calls speaking, I like to capture appreciation and lock in premium. For my cash secured puts, those are more so for my income generation. And I'll explain that once we look at the spreadsheet. And speaking of the spreadsheet, let's go over there. Okay, guys, looking at the spreadsheet for May 7th, let's run the numbers. For the first options trade I've done, it was the covered call. And the amount of premium I made for that options contract was about $61. It was a little bit higher than the previous 2 days because I was a little bit more aggressive and chose a strike price that was a little closer to at the money. Let me explain that. So the strike price I chose was the 566, and at the market open, it was the SPY was trading at 560.19. Therefore, usually I choose something $5 and $10 away, but this time I chose something in that, $5, $6 range. And I liked the premium at the time, so I backed that $61 premium. No problem there. But the way that covered calls work is you have to own 100 shares of the underlying. 100 shares is one contract. And I bought my first 100 shares of SPY at this 559.62. So basically, whenever I'm choosing my strike prices, I want to make sure that I don't choose a strike price that is at or below this number. I want to make sure that's above. So anything at this 560, 561 or higher is going to be good. So the fact that I chose this 566, I'm about almost $6 plus above that strike price. So even if these shares were to get assigned, I would be making about $600 of appreciation, but then I also locked in that premium. So that's my thought process for running my covered calls. Covered calls, I'm trying to capture as much appreciation as possible without getting my shares assigned, because I definitely want to have an asset that's going to be a long-term investment. Cash secured puts, on the other hand, I'm going to be a little bit more aggressive, and let me explain that. So the way that a cash secured put works is an investor is going to pay you an upfront premium to then offload their shares at a specific share price. And the only thing that you have to use as an investor is have collateral. And the collateral you can use is either margin or cash. Let's dive into the actual details. So the cash secured put that I ran against SPY, I usually run dailies, is I made $139 today. And I chose the 557 strike price. And when I'm saying I'm more aggressive with my cash secured puts, that means I'm choosing a strike price that is closer to at the money, and then trading at open, the at the money is at that 560.19. So I choose something that was $3 away. I'd be totally fine if this 557 strike price got assigned. I would get those shares assigned and then sell at the money covered calls until I sell it, because I technically would be a little bit on margin if I were to get them assigned. But ideally, I'm trying to use cash secured puts to increase the amount of premium I'm generating day in and day out. But strike price was 557, trade at the open was 560, and trading at close was 561. So this strike price for this cash secured put wasn't anywhere near getting assigned. And then even just kind of talking about holistically, this is why I advocate for an investor to choose a couple of investments and just understand how the market flows. Because I track the market Monday, Tuesday, the market looked very stagnant and there wasn't any big earnings coming out. So the market didn't move too much. So I could have technically made more premium the last 2 days, but I was more conservative. But then today I was like, I saw the market being very conservative. I'm going to choose some strike prices that are a little bit closer to at the money so I can lock in more premium. And then today I made $200 of premium in total. And if you look at the previous day, I only made $100. And in the Monday, usually when I do a week-long calls on a specific fund, I did it for NVIDIA. I made $173. So being more aggressive today netted me more premium. And I plan on doing this for the next 2 trading days, for Thursday and for Friday. But now that I got what I did at the tactical level for May 7th, let's take a holistic approach and look at how the last 18 trading days have elapsed and how the performance looks like for those days. You guys know me. I love to track the results and performance of the investments I'm owning. So for May 7th, $200 of premium. And then at the end of the trading day, my account's at that $91,454.92. The last 18 trading days has netted me about $3,458.53. And the amount of trading days per month is usually somewhere between 20 and 22. So therefore, I need about 2 more trading days before I can call it a first month on paper. But even though I started trading in April and then it's kind of spilled over into May, I'm going to compartmentalize some of the data in some of these spreadsheets. But if we look at that as a total return basis, I'm up 5.96% since I started trading options these about 18 days ago. Now let's look at the trade win percentage. For the trade win percentage, I'm winning 94.44% of my trades. I had 17 winning days, 1 losing day, and then total 18 days. The average premium per day is about $192.14. And then the average weekly premium is about $1,152.84. And the average monthly premium is going to be exactly what we talked about earlier because a month has not elapsed. So whatever this total number is going to be what my monthly premium is for the next 2 days. But also for me, I like to make some estimates with my current performance right now. I'm not saying I don't have a crystal ball. I don't know what the market's going to look like next week. I don't know, depending on what the administration is going to say, what the markets are going to look like. However, at face value of what's currently happening, if I were to push this out to about a 12-month period, I'd make about $41,502.36 of premium. And if we look at that as an average percentage compared to my $86,312.60 starting portfolio, that's a 48% return, which is far outperforming any type of high income ETF or just in general, the S&P 500, if you just invest it and sit there and then just want it to appreciate. So that's quite interesting. I don't know if this is actually going to play out this way. People can throw these numbers into ChatGPT, but each year the market is different. Each month the market is different. Each week the market is different. So past performance isn't going to be exactly dictating what future performance is going to look like. But now let's go over to the weekly tracker. For about the 4th week of me, maybe 5th week of me running these options, we're about 3 days into the May 5th week, and we're at $473 of premium. I still have 2 more days, and I definitely think I'm going to be a little bit more aggressive choosing premiums. So I'm estimating maybe at a minimum, I'm going to make about $673, but I'm trying to shoot for another $1,000 week. For the monthly tracker, April was $2,289.53, while May just started about 7 days ago. I'm at $1,169. And then the yearly tracker is currently what we have already showed earlier. Okay, guys, now that I talked about the holistic overview, I definitely think running your own options is safer. For me, making this $200 this morning, it took me 5 minutes. I came up with a strategy last night. Once the market opened, I waited about 15 to 30 minutes after it opened before I execute trades because whatever happens over the nighttime people get excited. The market opens, they start throwing money in there, and then it'll spike up. And then I was like, maybe we'll wait 15, 30 minutes, and then market kind of cooled off. Then I slid in, and then I ran my options, my cash secured put, and my covered call. With that being said, guys, let's head over to Robinhood. I'm going to talk about executing some trades, and I'm going to show you guys how to do it, and then I'm going to re-explain just cash secured puts and then covered calls. All right, guys, now that we are back at the Robinhood screen, you guys know exactly what I'm going to say here. Let's go over to SPY and then press on that money printer. Yeah, that money printer is trade SPY options over here. Every time you click it, money shows up in your account. I don't make the rules. See this buy button? Never press this buy button. 90 to 95% of options traders that press this button lose their money. So just do the safe stuff, sell call or cash secured put. So let's talk about covered calls first. To run a covered call in Robinhood, you need to do sell call. And a covered call is you own 100 shares of the underlying, 100 shares is one options contract. And the way it works is this bid price is an investor is going to pay you whatever this bid price is so that they can lock in a specific strike price for you to sell your shares to that investor that's paying you that premium. Let's take a look. Currently, the SPY is trading at the 566.08. And usually I like to choose a strike price that's about $5 to $10 away from the at the money, which is this 566.08. So let's see what +5 is to this. So 571, I don't know, $17 is a little bit light on premium. So I'm definitely thinking I might be aggressive. The after hours has increased this price about $6. I don't know if that momentum is going to transfer into the morning when market opens or pre-market. So maybe I might choose something at this 568 strike price or the 569. I'm usually conservative. I'll choose 569 because I'm going to side on appreciation more than premium when it comes to covered calls. Cash secured puts, completely different ballgame. But let's lock in this 569. So the way this works is investor is going to pay you this upfront premium, which is 0.33. It's actually $33. They're going to pay you this $33 upfront for if the SPY goes to 569, they're going to buy the shares from you and they're going to get assigned. And there's a couple scenarios that happens here. The first scenario is nothing really happens. An investor is going to pay that upfront premium, and then the SPY is going to stay at this, 566.08. You keep the premium, you keep the shares, you can rinse and repeat the next day. However, the other scenario that can potentially happen is that investor pays you that premium for that 569 strike price, and then the SPY price shoots over to like 570, 571. And so that at the close of the business day, you're going to have to get your shares assigned at that 569, but you also get that premium. But the way this works is you're also going to get that appreciation from this 566 all the way to that 569. So you get $300 of appreciation, plus you make this $33 of premium. So therefore, when it comes to the covered calls, you're usually going to make more money in the appreciation than the actual premium. And that's the way I view it. So I usually be more conservative and I want to capture the upside. Now let's talk about cash secured puts. So to run that in Robinhood, you do sell put. And I forgot to mention this, guys. I usually like to run daily options for my SPY shares. For when I do NVIDIA or Amazon cash secured puts, those are weeklies. And that's the only time I really run weeklies is for individual stocks I like. But for SPY, or if I eventually get into QQQ, I just do dailies because I like the ability to fluctuate my strike prices with the moves in the markets on a daily basis. I don't like just picking a strike price and then waiting for a week. Well, I will say this, if you don't have the money for owning 100 shares of SPY or QQQ or IWM, I probably recommend still running options on those funds like NVIDIA, Amazon, or whatever you think is going to be a market leader in the next 5-10 years. But let's talk about the sell put. So the way cash secured put works is investors are going to pay you an upfront premium so that they can offload their shares at a specific price. The only thing you bring is collateral, and that collateral can either be margin or it can be your own cash. So let's talk about the numbers and how this actually works. So let's take a look at some of these numbers. Let's see. 566. Yep. So the SPY is trading at this 566.20. And so I like to choose something $5 away from the money. These premiums are absurdly high, and I don't know why they're this high. But we'll choose something $5 away from the money. So let's choose this 561. So basically, theoretically, you would make $248 of premium. So investor would pay you that money, but what you're basically going to be trading is the ability to buy these shares at this 561 price. That's why you have the collateral there. They put that $56,100 of collateral to the side in the case that the shares at the end of the trading day are at 561 or lower. And so here are the two scenarios. Say you do this, you choose this strike price, get this $248 of premium, and the SPY never goes below this 561. It stays at 562 or stays at 563 or even just stays at the 566. You're not going to get this cash secured put assigned because the way puts work is you have to go below the number versus covered calls. You have to go above the numbers for your shares to get assigned. So for this 561, investor paid you that premium. Shares weren't assigned. Okay, great. Now let's talk about if they go below. Investor's still going to pay you that $248 of premium, but if the shares get assigned, you know, because the share price for a SPY is at 560, then you're going to have to use that collateral to then buy those 100 shares of SPY. And then at this point, then you can run covered calls, sell it, and do whatever you want with that. But I think for tomorrow, I think these premiums are a little bit too high. In the pre-market, they're going to change, so I'm going to reflect it. But I'll probably choose something at this 559 for this cash secured put, maybe lock in another $100, maybe $200 a day. And then for the covered call, I think, what did I say? The 568. It's a good number. 568 or maybe 569. We'll see. But yeah, guys, that wraps up the video. Quick, down to the point. Very simple options trading. I don't want to do anything complex. All of these trades I've done take me about 5-10 minutes in the morning of just kind of scrolling through strike prices and picking which premium I want. And so the way the options works is it's either you want appreciation or you want premium. You can't have both, right? So if you want more appreciation, the premium is going to suffer because of that. But if you want more premium, your appreciation is going to suffer. So basically it's finding your own right touch point. I can't give you that answer, but for me, I usually like to start with, $5, $10 away from at the money. So at any point, and then I work my way to the correct answer. That's just like a decent guideline. Some people will look at delta, some people look at betas and the different Greeks. It's a little too complicated, but to keep things simple, just look at share price and whatever premium you like, pick that premium. But just the one thing I will say is invest into a good fund that is actually a market leader. Investing into an ETF like SPY is great. Investing into QQQ is great. Investing into market leaders like Amazon, Nvidia, Microsoft, Google, those are great companies. So invest in good quality companies and then run options against those. So that's what I highly recommend. And the way you will never lose money is if you buy in at a certain price, just make sure your strike prices for your covered calls are above that. For cash secured puts, make sure whenever you get them assigned, just make sure when you run covered calls against it, put it above that price. And you'll never lose money. And this is the safest thing you can do. Yeah, guys, that wraps the video. Matt out. I will see you in the next one. And I hope your portfolios are growing. See ya.